Asian markets broadly fell as investors reacted to an overnight update from the U.S. Federal Reserve that indicated that the central bank plans to raise interest rates as soon as March. Japan's Nikkei fell 3.1% and the Hang Seng Index in Hong Kong slipped almost 2%. Chinese mainland shares also declined. The Fed reinforced its determination to quell the highest inflation in a generation amid a robust recovery from the pandemic. The central bank also said it expects to begin balance sheet reduction after starting rate hikes. Looking at what's happening locally in company news, grocery retailer ShopRite reported double-digit growth in the first half sales, despite the fallout from the civil unrest that affected 231 of its stores, mostly in KwaZulu-Natal and Gauteng. The group's SA Course supermarket business achieved sales growth of 11.3% and 10.7% on a like-for-like basis. Meanwhile, SA's largest furniture retailer, Lewis Group, reported that sales growth for the 9 months to end December showed momentum, adding that collections improved and credit sales had also improved on that front. To talk to us about how the markets are actually digesting the Federal Reserve's interest rate decision, we are joined by Han Tan, who is a chief market analyst at Xfinity. Han, thank you so much for your time. I mean, your initial takeaways from Chair Powell's comments last night.
So what I latched onto was Chair Powell's hawkish pivot, right? Because let's be honest, he's been rather late to the game. He only left it till late last year before ditching his transitory stance. So now it appears he's catching up with his more hawkish-leaning colleagues. So that suggests that the makeup of the overall FOMC, as we head into that pivotal March meeting, are leaning towards that rates lift-off. Now, I think the question then is whether it's a 25 basis point hike or potentially even a 50 basis point hike. I think that's what markets are still trying to digest right now.
Let's talk about that 50% basis point. I mean, that hasn't been done in a very long time, and it almost seems unfathomable that that could be an option for them. Could that be, if that does happen, could it be because, inflation is too persistent in order for them to deal with it? And perhaps maybe we have to entertain the idea that they waited too long.
Yeah, indeed. So you're right on both counts. So on one hand, I think the policymakers will have to be data dependent, like global investors and market watchers such as myself. If we see the CPI or other economic data that feeds into inflationary pressures, if they persist, then that I think really raises the prospects of a 50 basis point hike. And to your second point, I think it's about credibility, right? Because I think markets had expected the Fed to move sooner rather than later. Granted, that is overall still the case. It is still sooner than expected, but it seems like a 50 basis point hike would try to help restore some credibility to the FOMC, at least in terms of trying to curb those inflationary pressures.
Following yesterday's comments from Powell, when you look at the 2-year and the 10-year bond yields, what do you think it's signaling to us, given what we're seeing right now with it?
Yeah, indeed, and it's not just the spreads between the 2 and 10s. It's also, when I look at the 5 and 30, they are flattening as well. So I think that signals to markets that although markets are bracing for the more aggressive Fed, that also could raise the prospects of a policy error. So it looks like the Fed has got inflation front and center of its policy focus for perhaps the next 12 months and beyond, and perhaps at the sake of the risks to economic growth, right, and all of those other subsectors. So I think that is a message that we're seeing right now. Potentially, a policy error could also then give rise to a recession in the U.S.
On that note, then, I have to ask, is there a risk of some sort of financial instability increasing as the Fed gets more aggressive and as we start to see this tension between valuations and fundamentals?
Yeah, look, I think volatility will be the name of the game, for the weeks and months ahead, right? Until markets find this new equilibrium, so to speak, and I guess in simpler terms, to get more comfortable with the prospects of not just higher rates in the US, but also the prospects of the Fed unwinding this massive balance sheet that it had accumulated over the course of the pandemic, right? So even if you look at the VIX, the market's fear gauge, coming into this week, it already reached its highest since October 2020 or sometime in the fourth quarter of 2020, right? So, that kind of shows you the kind of jitters that are playing out in the markets. I think Powell's comments only ramped up those concerns. And I think we will still have some very, very pressing questions that remain to be answered, and possibly we could get some clues out of Fed speak or the economic data in the weeks and months ahead.
I'm going to put you on the spot here, and I can imagine there's a whole host of market news and global news that you're paying attention to as you look at your screens every morning. What's the key events that you're paying attention to right now, whether it's globally as well?
Yeah, so I think front and center is the path of policy rates for central banks, right? So obviously the Fed is front and center. Of course, you've got to pay attention in the FX markets to what the Bank of England or the Bank of Canada is doing, and also in my part of the world are Asian central banks. So if you look at the capital flows, whether or not this more aggressive Fed could actually spur a capital flight from emerging markets or Asian markets as well. So I think the asset allocation or the themes for 2022 and beyond, I think will be very much driven by what Fed and other central banks do.
Han, thank you so much for your time. That is Han Tan, who is joining us from the UAE, and he is from Xfinity Group, giving us his analysis on what happened in terms of market performance following Federal Chair Jerome Powell's statement.